Are you about to apply for a business loan, but not quite sure what lenders are looking for? Or maybe your last loan application wasn't approved? Here's the thing. Getting a business loan isn't just about having a great business idea. It's about proving to a lender that you're low risk, trustworthy, and financially capable of paying them back with interest. Now, if you don't know what they're really looking for, it's easy to feel blindsided by rejections, confused by the process, or even worse, you sign up for a loan you can't comfortably afford. In this video, you're going to learn what banks and lenders are actually assessing in your application, how to calculate your safe borrowing capacity, what to check in your cash flow before applying, why you must avoid high-interest loans and how to spot it, how to prepare your bank accounts, credit reports, and spending habits, the financial health ratios lenders love, and how to put together a winning loan application, step by step. You'll also hear client stories that show you exactly what to do and what not to do. First, work out how much you can comfortably borrow. Before you even look at lenders, go online and find out your borrowing capacity. Most Australian bank websites have a tool that says, "How much can I borrow?" Use it. Also on the Smart Money website, you will find some calculators. These will ask a few questions about income, expenses, and existing debts. Then it gives you a rough eligibility figure. That's your starting point, but don't stop there. Now pull up your own cash flow forecast or business budget. Ask yourself, how much could I comfortably pay in loan repayments each month without stressing, falling behind, or skipping wages? Compare your answer to what the calculator said. If there's a gap and your number is less, always go with your number, not theirs. Overborrowing is one of the easiest ways to get trapped in a repayment cycle that kills cash flow. And here's a smart tip. Check if you have any small loan balances with high repayments. For example, if you have a car loan that only has 6 months to go, the balance might be small, but the monthly repayment could still be quite large. In this case, it could be worth paying out the balance and closing the loan. That one change can really boost your borrowing capacity because it frees up cash for new loan payments. Lenders love seeing fewer active debts on your profile, especially if it drops your overall monthly commitments. Second, avoid high-cost finance, no matter how tempting. If you're offered a business loan with an interest rate that's 5% or more above the Reserve Bank's official cash rate, that's a red flag. That's what we call high-cost finance. And yes, some of these offers look quick and easy, but they come at a huge price. The repayments are brutal, the interest piles up fast, and you'll find yourself stuck on what I call the loan treadmill, where you're always running just to keep up, but never moving forward. Lenders like this count on you being desperate. Don't give them the satisfaction. If your business is healthy, you shouldn't need to go down that road. And third is credit history, both yours and the business. You guessed it, your credit score matters. And if you don't know what your score is, that's your first step. Go check it today. There are free credit check websites like Equifax, My Credit File, Experian, and Credit Simple. These sites let you request your report and score for free, usually once a year, and it only takes a few minutes. You don't need to pay for the upgraded versions unless you really want the bells and whistles. Once you have your credit report in front of you, look for any missed payments or defaults. Also look for old loans that might still be showing. And find any hard inquiries. Too many applications in a short time is a red flag to a lender. And here's something not everyone knows. If there's an error, like a bill you've already paid but it's showing unpaid, you can dispute it and request a correction. That can make a big difference to your score. If your score is low, don't freak out. You can improve it over 3 to 6 months by paying everything on time, keeping balances low, and avoiding new applications. And remember, business credit matters too, especially if you've got trade accounts or finance in your company name. Those payment histories show up as well. Keep your credit reports clean. And fourth, know what lenders want to see before you apply. Here's something most people don't know. Before approving your business loan, reputable lenders will look through 6 months of your bank and credit card statements, and they're not just scanning balances, they're looking for signs that tell them whether you manage money well or not. So, here's what you need to do before providing your bank statements. Make sure all your bills, subscriptions, and credit card repayments are up to date. Don't miss payments, even small ones. Avoid using buy now, pay later services like Afterpay or Zip. I know these are commonly used, but unfortunately, if you use these, lenders will assume you're overspending. And don't withdraw cash from poker machine venues. Sounds silly? It's not. One woman I know, she worked at a local club, and every payday she withdrew cash from the club ATM. A lender denied her loan thinking she had a gambling problem. She actually wasn't even allowed to play the pokies at her work, but the damage was done. Your spending habits leave digital breadcrumbs, and lenders follow those closely. So clean things up, and keep it clean for at least 6 months before you apply. Make sure your business financials are in good shape. Lenders love to see healthy ratios. The current ratio is current assets divided by current liabilities. The result should be above 1. In this example, 28,500 divided by 1,500 is 19, and that's a very healthy ratio. Profitability, net profit divided by revenue, to show your margins. Different margins are expected in different industries, but we always want to see this increase each year. Run these numbers yourself or ask your accountant, and address any issues before applying. If you're making a large purchase like large machinery, a home, or a rental property, it's a good idea to use a finance broker. Years ago, I would have said, go to your usual bank as the first port of call, but today I definitely suggest that you use a good finance broker because a declined loan application show on your credit report as a big negative. A good broker knows the financiers and their rules. They will assess your situation and only lodge an application that has a good chance of being approved. If you have a question, drop it in the comments. I'll do my best to respond. And please don't forget to like, comment, and subscribe. It will help you see my future videos, and I'll see you next time.